Imagine this. The Federal Reserve cuts interest rates. Everyone expects mortgages to get cheaper, markets to rally, and money to become inexpensive again. But nothing happens. Mortgage rates stay where they are, stocks twitch nervously, financial conditions remain tight, as if no rate cut ever occurred. Why? Because the Federal Reserve controls only one faucet. The water flowing through the pipes belongs to someone else, and that water comes from Tokyo. There's a story that almost never appears on Bloomberg and rarely makes the evening news. Not because it is unimportant, but because it has no heroes, villains, or explosions. Just boring numbers and quiet decisions made by Japanese pension funds. Yet those decisions determine how much you pay for a mortgage, how much the stocks in your portfolio are worth, and how expensive it is for companies to borrow money and expand. All of this is a consequence of what happened in Japan over the last 30 years, and what is beginning to change right now. In the early 1990s, Japan's economic bubble burst. Real estate collapsed, stocks collapsed. The country entered what economists later called the lost decades, a 30-year period of almost zero growth, near zero inflation, and near zero interest rates. The Bank of Japan did what central banks do when they find themselves in a hopeless situation. It pushed rates to the floor. First to zero, then below zero, and eventually it introduced yield curve control, a policy designed to keep long-term bond yields at a specific level whether markets liked it or not. The result? Japanese government bonds yielded close to zero for decades. Now imagine you are a Japanese pension fund managing a billion-dollar portfolio. Inside Japan, your money earns virtually nothing. What do? You go where the yield is. Into U.S. Treasuries yielding 4%. Into mortgage-backed securities, into technology stocks. That is how Japan became the largest foreign holder of U.S. government debt, the world's largest net creditor nation, and the unofficial ATM of the global economy. The mechanism is called the carry trade. The idea is simple. Borrow money in Japanese yen at close to 0% interest, convert it into dollars, and buy U.S. Treasury bonds yielding 4%. The difference becomes your profit. But the carry trade was never limited to treasuries. When borrowing costs are close to zero, investors do not stop at safe assets. They buy stocks, real estate, emerging market assets, anything that offers a higher return than zero. At its peak, the size of this trade was estimated in the trillions of dollars. In many ways, global financial markets ran on Japanese fuel, and that fuel was almost free until 2024. In 2024, the Bank of Japan raised interest rates for the first time in 17 years. Then it raised them again. Immediately after the second increase, the S&P 500 fell roughly 6% within days. Japan's Nikkei 225 dropped more than 12% in a single session, the worst decline since 1987. Why such a dramatic reaction? Because when Japanese rates rise, borrowing in yen becomes more expensive. Hedging currency risk becomes more expensive as well. Suddenly, that 4% treasury bond no longer looks attractive. The math breaks. Money begins to move back home. This process is called capital repatriation, and it is one of the most underestimated risks in global markets today. Here's the key point about interest rates. The Federal Reserve controls short-term rates. That is its tool. But mortgages, corporate borrowing costs, and stock valuations are tied to long-term rates, the yields on 10-year, 20-year, and 30-year bonds. And long-term rates are not determined by the Fed. They are determined by the market, by supply and demand. The United States issues trillions of dollars of new debt every year simply to finance its budget deficit. Someone has to buy those bonds. For decades, Japan was one of the most reliable buyers, a stable, price-insensitive participant that purchased debt almost mechanically. If that buyer reduces demand, the U.S. Treasury must attract others, and there's only one way to do that: offer higher yields. In other words, make money more expensive for everyone else. Investor Ray Dalio once summarized it this way: the bond market is the foundation of every other market. The risk-free rate determines the value of every asset. When supply and demand become unbalanced in the bond market, long-term yields rise, currencies weaken, gold becomes more attractive, and central banks find themselves trapped. That is exactly what we are witnessing today. First, do not assume mortgages will become cheaper simply because the Federal Reserve cuts rates. If long-term yields remain elevated, mortgages remain expensive. This is not politics, it is mathematics. Second, stock valuations also depend on long-term rates. Analysts discount future corporate earnings using these yields. If rates stay high, stocks trade at lower valuation multiples even when profits continue growing. Third, corporate borrowing becomes more expensive. When money is cheap, companies borrow, invest, and hire. When money is expensive, everything slows down. That is what people mean when they talk about tighter financial conditions. Instead of focusing only on Federal Reserve press conferences, watch Japanese interest rates and the yield on the U.S. 10-year Treasury. That is where the real decisions are being made. For 30 years, cheap Japanese money quietly subsidized the American economy. No headlines, no viral tweets, just a steady flow of capital that made mortgages affordable, stocks expensive, and credit cheap. That flow is beginning to reverse, and most people do not even know it ever existed. The most important changes in the economy are rarely the loud ones. They happen quietly, in the balance sheets of Japanese pension funds. While everyone is watching Washington, some of the most important levers in global finance are sitting in Tokyo. If you want to understand what is really happening in financial markets, subscribe. This is exactly the kind of story we break down here.